Philippian there from Bloomberg in Hong Kong. Let's return to our guest host today, Karl Siegling from Cadence Capital. Karl, really interested. We've obviously heard some bits from you already about your outlook and what you think of the US at the moment. Just how difficult is this market, and what's your strategy for making money still?
Well, it is. I mean, it is very, very difficult. Just listening over the last 45 minutes to all the different opinions and all the different information that's taking place, it makes it it's a very, very difficult process. I mean, fortunately, from our point of view, that isn't what we have to do every day. What we do is we go out and visit 300 to 400 companies per year. We visit with the management, the senior management of that team. We try and work out what their business model is. We try and work out what the earnings profile of their business is. We try and work out what the competitive situation is, their pricing power, their positioning within their industry. And based on that, we then evaluate the business and work out what valuation it's trading on based on its share price, the number of shares, the debt levels it has, the cash it has in the bank. And then we form an assessment on whether we're going to invest in the business or not. Now, when we do decide we like something, and we'll come back to an example of something we like that came out today, we don't risk the entire portfolio on it. We invest 1% of our portfolio into that position, and if the position goes our way, we add another 1% to it, and if it goes our way again, we add another 1% to it, up to a total of potentially 4 or 5% of the portfolio if we have something we really like. So what we're doing in that situation is we're adding to a position when our belief or what we thought was going to happen starts to happen. We call that we're pyramiding into the position, or we're pyramiding out of a position if the converse happens. In the 2007 crisis and 2008, we were reducing exposure. As the environment became less and less certain, we didn't really, it was very unclear to see what the earnings were going to be for companies. We reduced 1% on each of those positions, reduced. So if you did go and have a look at our exposure over that period of time, over, say, the last 5 years, you'll see a rising exposure followed by the falling exposure. And again, early last year, our exposure started to creep up as we were getting back into positions that we thought were cheap and were delivering strong earnings growth. So just for an example of that, today, a small company called Firstfolio reported and came through with the numbers of 10 to 11 million of EBIT. Now, ordinarily for most people that wouldn't be important, except that this company has oscillated between profit and loss for a long time. And the really interesting thing that they announced in that result today, they confirmed that next year they expect to do $15 to $16 million of EBIT. Now, 15 to 16 compared to 10 or 11 is at least a 40% earnings growth for next year. 40% earnings growth, that's very strong earnings growth. What valuation are they trading on prospectively next year? They're trading on a 4 times PE multiple. So we today, and we've actually been in this company now for a while, because the company announced about, I think 5 or 6 months ago, that they expected to do 10 or 11 million dollars of EBIT. We've been following this company for 5 years, and for the first time we've seen this really step change in their earnings. And so we added 1% to our portfolio. As it went up, we added another 1%. As it went up, they did a capital raising, we added another 1%. And so we've pyramided into that position and now find ourselves in a position that the management have confirmed today they believe will deliver at least 40% earnings growth next year, and is trading on a prospective 4 times PE multiple. Now, that is a lot easier for me to talk about and comment on in terms of where I think that company may be next year. Our risk for our shareholders now with that company is, does management deliver on that 15 to 16 million? But for them to be so confident, to be able to say at today's announcement that they believe they'll do 15 to 16 million of earnings next year, they must have a strong business model, a strong turnaround situation in place. And actually what is happening there is their revenue is now easily covering their fixed cost base, and every incremental dollar that they're earning, a fair percentage of that is dropping to the EBIT line and dropping through to profitability. I mean, there's an example of something that we're looking at the moment. Now, that wouldn't have been reported on widely in the news today. Not many people would even know that company. Yeah. But it is a company that administers mortgages. It has purchased a business from private equity a number of years ago, and it's a business that is in a turnaround situation. And from that point of view, we believe has the potential to deliver 100% returns over a period of time.
Yeah, so triple F there is the ticker code. It was up, what, 11% today? So.
Oh, did it finish up 11%
Yeah,
today? I
very
haven't had a
nice
chance to
lift
see that. Okay, but that, I mean, it had an affirmation today, what we call, it's affirmed something that we were expecting. It's delivered its 10 to 11 million, and management have indicated a $15 to $16 million earnings EBIT number for next year.